The following is a conversation with Connor Crabtree. Connor is a corporate finance manager with Honeywell International, a Fortune 100 company. He is also a private investor with a focus on future-shaping trends and technologies. For me, Connor has proven to be an incredible source of wisdom and insight on anything related to U.S. economics, cryptocurrency, and artificial intelligence. In this episode of the Highly Uncertain podcast, we discuss the future advances in computing, machine learning, and the philosophical implications of developing a machine that surpasses human-level cognition. We talk about money. What is money, and is it the root of all evil? Connor goes over the foundational reasons for why Bitcoin and other cryptocurrencies were invented in the first place, and what serious long-term problems they are going to solve in the future. We discuss individual privacy and why we should all probably be more protective over our data. We talk about the blockchain and how decentralization may actually help save the world from turning into an Orwellian dystopia. I hope you enjoy it, and here is my conversation with Connor.
Like if we were to discover, for instance, general artificial intelligence, not like specific specialized artificial intelligence, that's more of the machine learning nature. But if we were to discover general artificial intelligence, which is essentially singularity, it's not discernible from any other human being, right? In terms of its ability to make judgments, right? And make crucial decisions outside of like a uniform like algorithm, right? And there's a lot of research out there that suggests this is coming within our lifetimes, right? Well, if we suddenly were to discover that, and to your point, if that were in the wrong hands, that could be very, very bad for humanity, right? Because this gets into all that sci-fi type stuff where you start thinking about, well, if it becomes aware and it starts being able to make decisions that are in undefined circumstances like human beings can, because that's really where true intelligence comes in. It's creativity, right? To solve problems and things like that. So if you get an artificial intelligence that starts to harness that sort of power, just because of the extreme computing power that would be behind that, which is far more exponential than our human brains, that will be an unmatched power. And so we have to be very careful with how when we go about doing that sort of stuff, right? How we go about researching it and developing it. And, it's funny because I'm going to go on a little bit of a tangent here, but, people always talk about, well, this isn't natural and yada, 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 right? Like, oh, this isn't a part of human nature, or this isn't a part of the natural world or anything like that. And I always take a step back and I say, well, I think it's pretty arrogant to carve human beings outside of the natural world, right? Like we are ultimately a part of nature as well. Like I think a lot of times people think about nature and then they think about human beings separately, right? Because we're sophisticated as far as we know with respect to other consciousness. But ultimately we are a part of the natural world. And so if our race begins to move towards these technological developments, well, then that's what nature wills, right? And so for someone to say like, oh, this is unnatural, I would say, well, this is literally what nature has come to. All of the collective evolution of the last however many billions of years, right, over how much eternal time there is, over the vastness of the universe, we have all collectively evolved to this point through a lot of trial and error, right? And through certain genes being passed on and certain genes going away forever through extinction. And ultimately, this looks like it's going to be that next leap into evolution. I just don't know what it's going to look like. It's scary and it's also exciting. And who knows, it might end up being really bad for like you and me or the average person, or it could be really, really great. With every extreme technological invention that comes, jobs get lost and people are always worried about that. But typically, new jobs get created. And the best thing about technology, which people fail to understand a lot, is that technology is naturally deflationary. So technology leads to more efficiency for us in our lives. It reduces the cost of everyday living, and it ultimately allows us to be more productive. And these are all good things. But within our society, the way it's constructed, this extreme exponential deflationary force that is this technological advancement that we're seeing over the last few decades that's just continuing to pick up speed. This is in direct competition with our societal systems that we've constructed, because our societal systems are actually very inflationary in nature. And you and I have talked about that before, but eventually something's going to come to a head with those two concepts. And that's kind of like where things intersect. Like we talk about, there's a lot of different disciplines that go into this to understanding how they relate with each other. But ultimately, I believe we're entering this sort of turning in society where we're going to see significant disruptions, both through the AI space, like we're talking about here, and machine learning within business and commerce. But we're also going to see extreme disruptions within the technologies that we use for economic calculations, for our systems of money, like we've talked about in the past, and just how we go about living our everyday lives. And I'm not saying we're going to have flying cars or anything like that. Who knows? We might at some point. But the way that we go about our day-to-day lives and the way in which we react to these new technologies is ultimately going to lead to a different way that we relate to each other. And it's really fascinating. And obviously that's kind of why we're here, right?
Yeah. So there's two things I want to touch on from that. First, I think that a lot of people, you're right in the sense that a lot of people seem to believe that whatever's going on in the world right now is something that resembles an unnatural occurrence. I had an argument with somebody about cell phones, and how cell phones were unnatural, and I'm like, why is a cell phone unnatural? We are creations of the natural world. We evolved out of the mechanisms of the laws of physics, and we created cell phones within the laws of physics. It's not as if cell phones somehow exist outside of what ought to exist. I mean, it seems like magic to me, because I don't know how the screen lights up, right? But it's clearly operating within the laws of physics, and therefore I believe it's just as natural as anything, and it's about as natural as a beehive or a house. And I think that what we ended up getting at, which was the opinion of the other person, was that they believed at a foundational level that intelligent creation within our physical world just feels very unnatural to them. Because everything else that you see in the wild, right, the air quotes wild, is sort of like a primitive thing that just sort of is, right? Like when you see a lion killing a gazelle in the savannah, you're like, that's natural, right? And for whatever reason that seems fine, but us building factories and creating cell phones is unnatural. And then going far ahead on the whole, humans turning into cyborgs and brain implants, and then ultimately perhaps being replaced by something that's entirely non-biological. I mean, it's terrifying to think about, but it's also something that is entirely feasible considering our understanding of the laws of physics and especially like software. I mean, software is really, really strange. Yeah, I would agree with you that should we be replaced by machines, it sort of would. I wouldn't write that off as some sort of tragic, unnatural occurrence that never should have happened. Because if it did in fact happen, then it was sort of proof that it was sort of supposed to be capable of happening.
Right.
And yeah, that. If it does happen, I would say I wouldn't consider it a tragedy just on the very basis that it was capable of happening in the first place. Because, if you're upset about machines replacing us, well, then you need to be upset about the laws of physics. That being said, I want to talk about why you think tech is deflationary. What
Mhm.
That's an interesting idea that I'm not wrapping my brain fully around. What do you mean by technology is deflationary, economically speaking?
Yeah. So uh, throughout history, we've had certain technological advancements that have allowed us to progress our society forward. So when you think about the Industrial Revolution, we were able to come up with, trains and things like that that allowed us to transport on mass scales never seen before in short amount of time, right? And we can transport large amounts of goods and things of that nature, right? And so for that reason, trade was able to proliferate on a scale never before seen. But when that train came along, people that rode horses and, to a lesser extent, when we first invented cars as well, they also introduced the same types of mechanisms that trains did, right? And when we first had horses, but prior to these inventions, well, we had horses all over the place, and there were a lot of businesses built around, distributing horses and maintaining horses, and we had our entire society's infrastructure built to accommodate everyone rolling around on horses, right? And so once these inventions came along, they were much more efficient than horses, right? They allowed us to mechanically transfer things without the need to maintain them like you would have to maintain a living animal, right? And like I mentioned before, you could now do it on greater scales and move greater amounts of goods and services and things like that. And so because of that, the cost of doing business were drastically lowered, right? The cost of me getting a good that I produced for you from California to Georgia just got drastically lowered, right? I used to have to do it by, a buggy or a cart or something, and now I could do it by a train or a car, right? And so from that example, your shipping costs get driven down now, right? Because it costs less to do it through these mechanisms. And I mentioned the time piece, right? So your time costs now go down, and time is your ultimate scarce resource. And we can talk about that stuff a little bit later, but ultimately, as you have technological advancements, especially things that are paradigm shifting advancements, you see drastic deflationary pressures on the cost of producing things, which leads to deflationary pressures on the price of obtaining things as well, right? And so technology is very deflationary because of these reasons. And so as we have these extreme technological advancements, like, just the advancements in computing power or, e-commerce and things like that, we've seen trade be able to proliferate on scales for, marginally lower costs than they ever would have been possible. And that's reduced the cost for everyone in society as a result. And yet we still see prices rising throughout society, right? And the reason for that is because of our societal systems. Our systems of money are very inflationary, right? Like we talked about before. And then we also have, regulatory environments that are only getting bigger and bigger and more bureaucratic, which increase the cost of, efficient trade and things like that. And so you have these two mechanisms right now, extreme deflationary forces through technological advancement, and then extreme inflationary forces through those systems that we just talked about there, really kind of coming out ahead. And that's what's, for the most part, kept prices stagnant and even rising over the last however many decades, despite the fact that we have technology drastically decreasing the cost of doing business and drastically decreasing prices for us on that supply side. But ultimately, on the other side of things, you have things that are still pushing those prices up.
Okay, so as technology gets better and processes get more efficient, your money goes further. Mm-hmm. Your money is more powerful because things are cheaper to make.
Right.
And so that has an inflation or deflationary effect on the economy.
Mm-hmm.
But you're saying that,
mm-hmm.
the added complexity to the system is causing inflation. And
right.
So I wrote this down. I wanted to talk about the theory of money, like, because we were going to start this whole thing about just like kind of talking about like what is money, what is value. I also, now that you mention it, I want to talk about the cost of time when it comes to economics, like why time is the
Yes.
most precious resource, and why economics is sort of a is sort of a study of value and time, because it takes time to create value, and 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 so I want to go into that, but let's start off, because we're going to touch on this stuff. Let's just start off with what is money, and why is it a good thing that we have a system that allows people to keep track of their money?
Yeah. So we've obviously talked about this prior to this conversation, and I think this is a really important conversation to have with respect to the backdrop that we find ourselves in society, right? So we hear all these narratives about, oh, money is the root of all evil, or I've seen things like wealth is murder, that type of stuff, right? And ultimately, all money is a technology that we discovered through necessity, like we talked about, right? And so to explain that further, we need to take a step back and really talk about what society looked like prior to money, okay? And what we ultimately had was extremely inefficient trade. And trade is where I enter a transaction with you, right? Where I say, hey, I have a good, let's say that I'm a chicken farmer, okay? And you are a strawberry farmer. Well, in this instance, if there's no money, if I want strawberries, I have to hope that I come across you, right? And I also have to hope that you as a farmer of strawberries, and I also have to hope that you also want to trade your strawberries that are in season for my chickens, okay? And my chickens have to be healthy and all of that stuff. So the cost of doing trade through this barter system, which is what we had prior to money, was very inefficient, right? Sometimes it took months for us to complete a trade because of the seasonality of goods. And we had to always have this coincidence of wants present through this barter system. And this coincidence of wants ultimately led to an inability to perform economic calculations, because again, if I want strawberries, but you're a blueberry farmer, well, I have to go searching that out, and that's really hard. So naturally what happened throughout time is people started to converge on goods that ultimately are very saleable. And what saleability ultimately means is the ease to sell that good onto the market at any time that I desire for the lowest cost possible. And so the most sellable goods naturally became the goods that we started using as money throughout human history. And so when we think about saleability there's really three components, okay? So the first component is going to be scale, and then the second component is going to be space, and then the third component is going to be time. So an example of this is gold, right? Gold isn't the first thing that we used as money, but it's naturally evolved into one of the better forms of money throughout history because of the credibility of its monetary properties with respect to those three components of saleability. So in terms of scale really just means how divisible is it and how recombinable is it as well, right? So in my example, if I have chickens and you have a bunch of strawberries, well, how do I know how many strawberries is going to equal a full chicken? Or what if I just want 2 strawberries? I can't just cut my chicken down, right? Otherwise my chicken dies and now the trade isn't going to work, right? So gold was divisible to a point where it was easy to cut it down so it could facilitate smaller transactions. And we could also recombine it into bigger value amounts so that we could trade it for bigger things that were much more valuable in nature, like a house, for instance, or something like that, right? So that's the first part is scale. Scale. That's extremely important.
So also, I would imagine that, it's easier to ensure the quality of gold than it is to ensure the quality of a chicken or the quality of a strawberry, right? Like you have 100 pounds of strawberries, they might look like good strawberries, but you don't really know until you eat them. Right. But with gold, there's sort of tried and true ways to figure out how much value of gold do you have in this moment, right? Like it can be melted down and it can be weighed and it can be, you can be sure that it's roughly speaking, it's worth what we both think that it's worth.
Right, right. And that gets into the next 2 points, which are space and time, right? So gold is essentially durable and reliable through space. And what that means is I can transport it, right? And so it has ultimately a high value to weight ratio. So what that means is I can store a high amount of value in a small piece of gold, right? Like an ounce of gold, which is like about that big, is worth well over $2,000 right now. So it's transportable relative to some of these other goods, right? Like transporting a bunch of chickens is going to be much harder than transporting a small amount of gold, right? And so that's the salability across space. It's lower transport costs, and it's also more efficient to transport. And then the ultimate one is time, like you're talking about, with reliability and durability. So the good has to be able to hold up through time in order for you to store value in it, right? So when you're saving your money, that money needs to hold up throughout time and not diminish in value. And so certain goods lended to these properties better than other goods. And so like the strawberry example, right? I could try to store my value in strawberries, right? Hoard up my strawberries, and I can eventually trade them for other things. But those strawberries are going to go bad eventually, right? They're going to rot. And so they're going to lose their value over time. Gold is very durable. It persists throughout time. It doesn't change throughout time, right? It remains consistent throughout time. And then the biggest thing here, the most important thing in my opinion, and I would say in most people's opinion that really study this stuff thoroughly and throughout human history, is this concept of scarcity, right? If someone is choosing a good because it stores value across scale, space, and time, well, then they're naturally going to demand that more, right? And as more and more people demand that, right, more and more people are going to want to produce more of it. So this good needs to naturally be inelastic to demand. The good supply needs to be inelastic to demand. And what that ultimately means is it has to be really costly, both in terms of like human capital and resources, and also in terms of time to go produce more of it. Otherwise, a bunch of people could just go produce things like seashells in the past that were used as money in human history. So Native Americans used seashells, which were great because they were relatively scarce within North America for these tribes that used them to trade back and forth with one another. But as soon as colonists came, they realized that seashells were being used as money. They introduced gold coinage, which was much more scarce than seashells because colonists could go find seashells a lot easier and introduce a lot more into the market. And so ultimately what happened is money is nothing more than a means for us to communicate with each other and keep score. So the simplest example I use is, let's say there's 10 goods in society, right? And there's $10 in society, or we'll just say 10 seashells using the example that I've been using. So in this society, there's 10 goods, there's 10 seashells. Each person has a seashell, there's 10 people, right? So naturally, let's say like all goods are relatively about the same value. They're each going to be worth about one seashell. And that's how trade's going to work. But if I'm able to go quickly, if I come into this market and I see that, oh, all I have to do is get a lot more seashells and I can control the goods and services, well, then all I'm going to do is I'm going to go to the shores. I'm going to find a lot more seashells, rare seashells and things like that, and introduce them into this market of 10 seashells. Well, if I find 10 more in a small amount of time and it's relatively easy for me, I can introduce them. There's now 10 seashells plus another 10, that's 20. I get to spend those 10 seashells into the new market. So the market hasn't accommodated yet for the fact that the supply of seashells just doubled. So I can buy these goods at the one seashell rate, and I can buy up all the goods and services and create wealth for myself just by easily introducing less scarce seashells into the market. And so that's why scarcity is so important when it comes to money. For money to uphold its value throughout time, it has to be much harder to produce more of it, right? Its total base that actually exists, the new introduction of new money to that base has to be a very small percentage of the total base that already exists. Otherwise, you start to experience things like the devaluing of the money that people use. But the biggest thing is the free market determines what money is best based on the credibility of that individual goods, monetary properties. And so throughout free markets in history, each individual started to realize that certain goods would be able to be exchanged to other people more so than others. So individuals started choosing those goods to save their money and then facilitate trade with. And so the markets from that individual standpoint started to collectively converge on the goods that were the best forms of money. And that's how we went from seashells to cattle to salt to even like cigarettes and prisons, to eventually converging on monetary metals and ultimately converging on gold, because gold best represented these monetary properties. And the biggest thing is gold is the most scarce compared to all these other goods that have been used throughout human history. And gold was really the center of our monetary system up until 1971, when we got away from things. And I know I'm starting to really go on a tangent here, so I'm going to give you a chance.
No, that's good. That's good. That was my next question. It was going to be centered on why is it a good idea for money to be based on something that exists in the physical world?
Mm-hmm.
Why was it? Okay, let me back up. Why was money originally? Why was the U.S. dollar originally based on the gold standard? The form of value that existed in the physical world, and then we went away from that. And then, I also want to talk about why is it important that money is based on something in the physical world in the first place, and then we can go into whether or not you can have money that's based on something in the non-physical world, and then we're probably gonna get into the talks about cryptocurrency and the scarcity of a digital asset, and how that's even possible. Because I think that a lot of people that I've talked to, they didn't take cryptocurrency seriously because they didn't understand the technology behind it and why scarcity is allowed into the system of cryptocurrency,
right?
And why it's perhaps just as durable as a currency that's based on something that exists in the physical world.
Yeah. So, I mean, you touched on a number of things there. So, like when we think about money, right, and people wanting to anchor it to the physical world, right? So, value is subjective, in my opinion. And so, like, the best example I give to people is we all breathe air, right? We all demand air. We all need air to live our lives, as far as I know, at least, right? But ultimately, air is abundant to all of us. So we don't have to pay anything, even though we value it very much, right? So that's one example of how abundance affects what we perceive as value, and then pricing versus other things, right? Like, we're not going to pay any money to go breathe air. But as soon as we want to go scuba diving, right? Well, all the air is gone. So what do? We go buy a tank of oxygen, right? And because air just became extremely scarce, right? So in that situation, we're now willing to pay for air. And so because value is subjective, value cannot exist outside of the realm of the human mind, essentially, right? And for that reason, because value is subjective with respect to humans, time becomes our most scarce resource, and therefore our most valuable resource, because given enough time, we can go create and produce pretty much more of anything in the material world, of the material world. However,
even gold.
We could go mine asteroids eventually with Elon Musk or whatever you want to do, right? But time, not only can we not produce more of it, we don't even know how much of it we have individually. So ultimately, money becomes a mechanism for us to store value, otherwise known as storing our time, right? Our hard-earned, produced energy, that our hard expended energy is what I mean, right? All the capital, intellectual resources that we pour into producing value for ourselves, that's all a function of time. And so ultimately, we are storing up time, right? Like, people talk about, oh, money is freedom, right? Money is freedom to do what you want with your time if you have enough of it, right? And so when you think about anchoring money to the natural world, it's really just ensuring that it's anchored to the fact that you have to spend time to produce value. And so when you think about a digital currency like a Bitcoin, right? And people say, well, I can't hold it. So, like, how does that have value? I don't understand. Well, Bitcoin is naturally scarce. There will only ever be 21 million of them. And we can get into that, the technicals later on if you want. But the biggest thing with Bitcoin is it isn't just magical internet money that's created out of thin air. In order to create more Bitcoin, it's a very similar analogous process to creating gold, in that you have to endeavor into expending capital resources, and expending energy in the form of electricity, and then ultimately expending time to go and ultimately mine more Bitcoin through computing power. And so Bitcoin is naturally anchored to our natural world. There cannot exist more Bitcoin unless we endeavor to go and produce it through a costly means. And money is worthless if it doesn't cost anything to create more of it, right? Because then we can just create as much of it as we want, and that gets back into the scarcity thing like we talked about.
Okay, yeah. So the Bitcoin mining thing, it's an interesting analogy to gold mining.
Mm-hmm.
But the difference between Bitcoin mining and gold mining is that you get gold after you mine gold. When you mine Bitcoin, what you're doing is you're solving math problems, essentially, right? And you're using GPUs and CPUs and stuff like that in order to solve these math problems by using electricity and using the intelligence and the work of computers in order to solve these math problems. And then you essentially earn small amounts of Bitcoin every math problem that your computer solves, right? Is that a fair kind of summary of how Bitcoin mining works?
Yes. And so like you can think of it like the gold rush, right? When there was a gold rush, what was everyone doing? They were all getting their picks and shovels and going to the places where they thought they could find gold, right? And you were kind of going in blind a lot of times. You would explore and you'd hope you'd happen on a deposit, and then you would get the mechanisms in place to extract that gold if you were lucky to find a deposit. It's really similar for Bitcoin mining. You have these supercomputers. So there's a bunch of different miners out there. They're distributed all over the world, and they're all competing every 10 minutes to find the next deposit of Bitcoin, which is essentially a block. And the block is essentially the next set of transactions that will be deposited forever in an immutable way on the Bitcoin blockchain, which is nothing more than a database. It's a way for everyone to verify all the information at once. It's essentially like double entry accounting. This is the next evolution in double entry accounting. It allows everyone to verify at all times which party has what, and it's all verified by that system of mining.
Okay, so the difference between Bitcoin and gold is that we don't actually know how much gold exists in our physical realm, right? Like we don't actually know how much gold exists.
Exactly.
Like you said, we could mine asteroids, and then all of a sudden now there's way more gold than we thought that there was. But
and there's a lot of gold in the crust of the earth still that's untapped, and we'll have the technology to reach that too eventually.
Yeah. Sure. But I guess, the difference between gold and Bitcoin is that we arbitrarily decide how much Bitcoin we're going to limit, right? Like we're going to decide. I don't know who decides this. I have no idea, but somebody or something decides this is the cap. This is how many Bitcoin are going to exist, and once and that's that. And then there's the halving and all that, which I'm also very confused about. But the amount of Bitcoin, the limit. The total amount of gold in the world, so to speak, we just sort of decide, and then we agree on it, right? Now, why?
Okay, so why the total supply for Bitcoin, and like why was it chosen that way?
Well, I understand why we decide that there's going to be a limit, right? Okay. We can't just say, oh, well, anyone can create Bitcoin and there's no limit. And it's like, well, because then someone who invents a really, really nice computer, then they can just make a shitload of Bitcoin, right?
Yeah.
But we decide to, we invent the scarcity. We say that there's going to be a limit, so that therefore it's a durable system of currency. But why the first and foremost, why did we decide that there was that specific limit, and also who decides what the math looks like?
Yeah. So the creator of this network is a pseudonymous person,
Satoshi,
or collection of people. Yes, Satoshi Nakamoto, right? And this person essentially introduced this network on a cypherpunk mailing list. And it was really the culmination of decades of interdisciplinary research leading up to its invention. Satoshi essentially stood on the shoulders of giants and was also an insane genius in his or her or their own right. But ultimately, so the supply cap, it's 21 million. It could be 100 million. It could be a billion. That doesn't matter. What matters is the fact that you have a fixed pie, right? That is 21 million. And you could sliver it down however much you want, right? So you think about a pie, you cut it into 10 pieces. Well, theoretically, you could cut it into 100 million pieces, right? So when you think about that 21 million supply, that's just a number of pieces that ultimately add up to the total network pie. So what's really important is that that pie can't continue to expand over time with respect to people wanting to produce more of it easily, like we talked about. And the important thing as well is that you can divide that pie into as many small pieces as you need to in order to facilitate exchange and trade, right, at small levels. Just like you can take $1 and you can break it down into pennies. You can take 21 million Bitcoin, which are 21 million pieces of that Bitcoin network. And you can also divide them down into something called a Satoshi. And a Satoshi represents 1/100 millionth of a Bitcoin. So Bitcoin is more divisible than anything we've ever seen, really. Much more divisible than gold, which is really the oldest form of money we have. And so the 21 million number, it could be 50 million, it could be whatever. That's just what they decided to say is your unit of account that you're going to divide that pie into. And then from there, you're able to divide it into even smaller pieces and then recombine them into that whole pie if you really needed to as well. So that's kind of what the thinking was there, and that's the approach. And 21 million is definitely an arbitrary number. I was number 21 in high school, so I like the 21 million personally, but yeah, that's another topic.
So okay, so now, so that makes a lot of sense. Mm-hmm. How is this qualitatively different than the money system that we exist in now? And right. I want to speak more specifically about the addition of currency to the system. So the Fed prints mm-hmm. money, and from what I understand, there's a good reason for this. Okay, now mm-hmm. When I was younger, I was always very like. I was like, why are we printing money? I mean, that's just like it seemed like an absurd thing to do, and it seemed obvious to me that it was just going to devalue the existing money, and you can't continue to do it forever. But I read a book by Ray Dalio, and he explained why our economic system is the way that it is, and why that we print money. And I think that one of the ways that he explains it is this little thought experiment where people are giving out tickets, in order to spend on things and stuff like that. Like I think it was a ticket system that was given out to people, and it was a real experiment where it was like the tickets were used to like go see movies or something like that with your spouse, and what ended up happening was you could trade the tickets and all that, but I'm totally butchering this whole thought experiment, but the long story short was that if more money wasn't added to the system, people didn't spend. So how does if the blockchain or if Bitcoin, if it really is a truly capped number, and it can obviously be divided up into a essentially infinitely small, unit of measure, mm-hmm. is it safe to say that Bitcoin, there will never be any printing of money, so to speak, in the Bitcoin realm?
Yeah, so that's a really good framing, right? So now we're talking about the current financial system that we find ourselves in, and Bitcoin was really born during the last great financial crisis of 2008, 2009. In fact, the very first block that was ever minted on the Bitcoin blockchain, it included a timestamp on it that will be there forever because it's immutable, it's uncensorable, it cannot be changed because of the decentralized nature of the network. But this timestamp included, I believe it was like a London or UK Times headline. And the headline was with respect to another series of bailouts that were being planned during that 2009 episode where we saw the Fed and central banks around the world bail out people that essentially would have gone out of business and things like that because they didn't necessarily perform the types of practices that you should to ensure your long-term survival. And so Bitcoin was created in response to that money printing. So the bailout is just another word for we're going to create money and give it to these people that should be going out of business for decisions that they made, right or wrong, and we're going to save them, right? And there's a lot of people that believe that that introduces moral hazard into our financial system. And we're seeing that play out today where the Fed has, since March, created well over $3 trillion. And that money, the way it gets into the markets, it first has to get injected into the markets through the banks. And then the banks allow that money to then flow to financial institutions that they have relationships with. And then, other people that are kind of insiders that they have relationships with. And then the theory is that money will eventually trickle down to the rest of the economy. But this is where the Cantillon effect comes in, which is this observed effect where those who are closest to the creation of money, they're the ones that get to experience that money in the form of income first, right? Whereas people furthest from the creation of money, they don't get that initial created dollars, right? So the money isn't neutral, right? It's not like this helicopter that's dropping $5 to everyone and everyone gets the new money and everybody is equally better off. The people closest to the money creation, the banks, the financial institutions, Wall Street, political insiders, Silicon Valley companies, elites, things like that, they get to recognize that new money creation in the form of income that they get to then spend into society. And the people furthest away, they get hurt because they're holding dollars, their savings, right? But their savings are now getting diluted because there's now more dollars competing with the dollars that they already had in the economy, right? And so this Cantillon effect is what a lot of people believe has led to the significant wealth inequality that we've seen really proliferate over the last 5 decades or so, dating back to 1971, 1973, depending on when you want to draw that line. And it just so happens that that's the date that we went off the gold standard. So the dollar used to be linked to gold at a set rate where you could redeem your dollars for gold, right? But what happened was because central banks and our government has the ability to create money, create more dollars essentially at a whim without any cost, what we'll do is we'll have the incentive to spend above our means, and we'll pay for that spending by just plugging the difference, right, with more dollar creation. So if I have $10, but I'm consuming $15 worth of goods and I'm taking out debt and things like that, well, I need to somehow pay that $5 back, right? Well, in the most simplified form, what we see happen is the government and the Fed creates $5 to pay for those things. And so that's a privilege that the United States has had on a global scale for a very long time because our dollar is the world reserve currency. And so when the dollar was pegged to gold, what we were doing is we were living above our means and we were printing more dollars than could actually be turned in for the amount of gold that we had. And countries around the world started to realize that this was happening. And countries started turning in their dollars for gold at rates that started to alarm our government to the point where our gold reserves were dwindling significantly. And because of that, Nixon came out in 71 and declared an emergency measure, right? Emergency measures, just like we're seeing today, right? Where just temporarily we were going to remove the redeemability of the dollar for gold. And that allowed us to make sure that we were protecting our real money, our real value in gold, versus the paper that we were putting out into the world saying, oh, this is redeemable for this real money. And sure enough, couple years passed and this emergency measure became the new norm. And this is ultimately how central banks around the world have co-opted gold, real money, and that is stored as reserves across all these major countries in the world, right? Despite the fact that these dollars in other currencies around the world are no longer redeemable for gold like it used to be on a standard, these banks will still argue that the dollar is valuable intrinsically and that gold doesn't really have intrinsic value, yet they still store all of these things on their balance sheets, and they're actually increasing their reserves significantly over the last 5 years or so. All of the major countries have. And it's because they know that they're devaluing their currencies at rates that we've never seen before, on scales that we've never seen before. And they need to make sure that they have real value to back this up if their experiment ends up going south. So Bitcoin was really created as a response to the mismanagement of currencies around the world by governments, right? Because governments can't seem to consume at least even or less than they take in as tax revenue and then revenues from services that they provide to their countries, right? And so Bitcoin really is the technological solution, the mother of invention, right, is necessity. And this person or group of people recognize that this was an issue that hurts the everyday person because it devalues people's savings, right? And if you're devaluing people's savings, you're ultimately stealing their time, right? Because your savings are a representation of that stored time, right? Your hard work and energy that you put into producing value for yourself. And so as we create more and more currencies throughout the world, more and more dollars or pounds or yen, whatever it might be, as we create more and more of these units, we are naturally devaluing and stealing people's time from a metaphorical sense, the everyday person's time. And Bitcoin is a direct response to that. It's essentially a competing money, right, in a free market that is now challenging our current legacy system.
Okay, yeah. So that helps me understand why, what triggered the technology to be pushed forward. But I'm interested in talking about what if I asked you what is the US dollar now based on, what would you say? I mean, because it's like, I understand that a lot of countries' currency, a lot of other economic systems sort of are closely tied to the US dollar. But what is the US dollar tied to? What is it actually based on, and how is it justifying its own value?
Yeah, so that's where you got to take a step back, right? And the dollar was based on gold, and people understood what gold was really all throughout, the U.S.'s existence. Up until recently, people have been learning more and more about what gold's place used to be in our financial system. But ultimately, gold is real money, and it's been money for thousands of years. And the dollar was based on gold. And so people knew they could redeem their dollars for gold if they needed to, but dollars allowed the facilitation of trade better than gold did because, paper is more transportable. It's not as heavy as gold, right? So it doesn't cost a lot to store it and things like that. And so up until 1971, dollars were perfectly fine. But now, like you're saying, they're not backed by gold anymore. And so now they're backed by the full faith and credit of the U.S. government. And so ultimately, money is a belief system. This dollar system has really been co-opted by governments. They kind of like slipped the gold piece out of it. And people didn't really know what that was going to look like when it first happened in the 70s. And so we saw significant inflation in asset prices across the board going into the 80s, like massive periods of inflation. And the way that governments got that under control is they largely raised interest rates to levels that haven't really been seen in the U.S., like close to 20%. And right now they're down to 0%. But back to your question, what are dollars backed by now? They're backed by governments and the ability for governments to manage their power with respect to other governments in the world, right? So if the U.S., for instance, were to get into a war with China right now, right, and just like World War II, where Europe got decimated, all these currencies devalued greatly in World War II when their countries got decimated by it, because they weren't backed by a government that could still provide value and economic output with respect to other countries, right? And so all of these fiat currencies right now, so the U.S. dollar is a fiat currency, the yen is a fiat currency, the pound, and so on and so forth, the euro. They're all fiat currencies, and they're all competing with each other on a relative basis in terms of their value. And so right now, the U.S. economy is still one of the strongest economies in the world with respect to other countries. And the U.S. dollar is still the center of world trade. So when countries want to trade with other countries on like for oil and for timber or whatever the resources they need, they do it. About 80% or more of world trade is settled in dollars because that's the system that we run on. And I don't want to get too ahead of myself, but essentially the system that we find ourselves in really since the 70s is a credit financed system. So we create more dollars in the form of more debt. And that's how we pull consumption forward, which allows us to live above our means and things like that. Whereas it used to be an equity financed economy where people would save their capital up and then they would use that capital, perform economic calculations to produce goods and services that were of value to others. And now it's, hey, here's some debt, take this debt and go and try and outgrow your debt. And so that's the type of environment we found ourselves in over the last 5 decades, really. And it's really come to a head over the last decade.
Okay, yeah. And that value based on debt, that currency that's sort of centered around debt, it's like, okay, when I have a friend who works at Vanguard and he's a financial advisor, and we were talking about the stock market and we were talking about the trillions of dollars of debt that the United States is in and how it doesn't really matter because the United States economy is still very good, and as long as there is growth in our stock market, as long as there's growth, then our economy and our dollar is going to be valuable. And the debt crisis, as it's called, I guess the more I've learned about the debt crisis, it's settled a couple of my concerns, but it's also sort of introduced a couple of concerns. Like the more you know about it, the more incredibly complex you realize that it is. But from what I understand, the reason why other countries are loaning us essentially an insane amount of money is that they actually believe that we're going to pay them back because we don't default on our debt. We actually do service it, even though it's at an insanely high total, I guess, principal amount. What do you think? I guess, like to get back on track, what do you think is the future of? I mean, and this is obviously like an insanely difficult question to even touch on at all. But what could happen in the future when it comes to this increasing debt that the United States government is in, and the prospected devaluing of the United States currency when it comes to how other economies how they view the value of our currency?
Right. So really, over the last 15 years, an economic theory that has started to arise and has now really became at the center of our actual actions from a Fed standpoint and from our government standpoint is this thing called modern monetary theory. There's actually nothing really modern about it. And it's not really a theory. Like just calling it a theory doesn't necessarily mean that it has merit. And so ultimately what it poses is because the Fed and our government control the dollar, right? And we can create more of the dollars if we need to. We can theoretically take out as much debt as we want that's denominated in dollars, because if I take out $100 million in debt, right, and I end up not being able to pay it back because I haven't produced and outgrown that debt, right, by creating real value for myself, well, then I can just create $100 million and pay back the debt. That's called monetizing the debt. The problem when you do that gets back to the scarcity piece that we talked about, right, and the cost of money, right? If the cost of money is simply just clicking a button on your keyboard and now I have $100 million, well, I mean, you're ultimately just devaluing the value of your currency. And it's like, I'll put a great example for you. If all governments could just create more money, right, out of thin air, and it would make everyone better off and it would provide all this value to the world, well, why don't they do it? It's because creating more dollars, more paper, or more numbers on a screen is never going to equate to creating real value, which costs time and energy and all that stuff we talked about. And so what this modern monetary theory poses is that we will be able to control the debasement of the currency, which will ultimately be inflation, right? Like if you're just creating so many more dollars, they're now competing for the same amounts of goods and services out there, so the prices are going to rise. That's what people are concerned with, because you could potentially get hyperinflation like we saw. So the Germany Weimar Republic in the 1920s after World War One, Germany, in order to pay its war debts that they were put into for losing World War One by the other countries that they fought against, they started getting the printing press going to pay off those reparations that they owed, and that created extreme hyperinflation in the 20s, which led to ultimately their economy getting ravaged, and it led to Hitler rising to power, right? So the concern is that we're going to eventually see significant inflation show up in the next few years here, because essentially the Fed right now is endeavoring into this modern monetary theory where, hey, we control the currency, and so we can create as much of it as we need to pay our expenses, right? Which is fine, but eventually we need to be very, very concerned about the potential for inflation on the back end in the next 5 years or so. And the theory poses that, okay, we can worry about that later. And when it does start creeping up, we can raise interest rates significantly and also tax people significantly in order to remove dollars, from the market, right? Which will help bring prices down. The problem with that is it doesn't take into account that slowly people are starting to realize that, what did mom tell you when you're growing up? Money doesn't grow on trees, right? You can't just create it out of thin air. And so money ultimately is a belief system. And people are starting to slowly realize that maybe this money isn't real money. Maybe there's something a little bit, fishy to it and whatnot. And that's what's really concerning, because ultimately right now, our financial system, for it to operate, it depends on most of the people that live in our system that are subjected to it not truly understanding how it works. Because if people realize these things, Henry Ford had a quote, I think, where he said, if the average person woke up one day and understood how the financial system actually works, they would essentially have guns in the streets by tomorrow, right? And it's one of those things where, our federal government essentially has a monopoly on money. So money is not a free market anymore, right? And if you have a monopoly on money, you can't truly have a capitalistic society either, because you can now do all these things to interfere in that society, right? So you can have a capitalistic economic system, but if you have essentially a monopoly on money, you can privatize those gains for the people that are closest to it, to the money creation, right? And you can also socialize the losses. And that's ultimately what a lot of people think these bailouts are. And you asked me earlier, why is the Fed doing this stuff? Because we live in a world of trade-offs. Ultimately, a lot of people are going to get hurt in the short term if we don't bail people out, right? But what ends up happening is we create an even bigger problem down the road, because we don't allow for capitalism to naturally take its course, for things to cleanse, for bloated, inefficient means of allocation to cleanse themselves, and for better entrepreneurs to come in and allocate resources better, because that's how growth happens, right? And so people are very worried right now that we're just going to create an even bigger event 4 or 5, 10 years from now. If we continue doing what we're doing, just like we did in 2008, 2009, we were talking about hundreds of billions of dollars at the time. Today, we literally have Congress right now arguing over whether we're going to do $1 trillion or $3 trillion in stimulus, right? So it's gone from discussing hundreds of billions to now we're $2 trillion apart just on one bill that we're potentially going to pass. And so that's what people are really concerned about, that believe in, sound money theory, which is all about ensuring that the money supply remains scarce and out of the control of a centralized group of people that can ultimately use it for their own whims, right, at the expense of everyone that's subjected to the system.
Okay, so what you're saying is that our government, we don't allow the right amount of Darwinism to take effect when it comes to big business, economic, bailouts and stuff like that. We need to be more unforgiving and Darwinistic about how we handle fragile institutions, right? Because if we don't, then we're just sort of like we're not letting the unsustainable ideas fall by the wayside, we're perpetuating systems that don't operate in robust economic situations, right? Like that,
Right.
like there's a lot of talk about the airline industry and how, they were just instantly bailed out, and it was like, there's a lot of controversy over that when COVID happened because obviously their business model completely broke down. Why was it so? Why was it so? It seemed like it was just such an obvious decision for them. They didn't think about it very, very, very long. It seemed to just sort of like bail out these institutions that. I guess let me ask you this: should that have happened, or like you said, should we have allowed more Darwinism to take effect and let these problems just happen and just like just cry now as opposed to later?
Yeah. Again, that's the trade-off, and this is where history is so important, right? So today, like you said, it was done. These bailouts were done like that, pretty much, right? There wasn't a lot of thought to it. It was very fast and expedient, and if you go back to 2008, 2009, the bailouts were a huge debate. They were debated for months, and that was the first time, like, really in the modern era that we saw something on this scale in terms of a bailout, 2008, 2009, and they were alluded to as temporary measures, right? These are emergency measures. These are just one-time things. We're going to do this to fix things. The financial system's going to be propped back up. We're going to have everything operating like it should be, and then we'll be fine moving forward, right? But sure enough, what we did is we introduced moral hazard in the system. The people that took out debts and took out excessive leverage in order to exponentially go after gains, right? These people, they were acting irresponsibly with respect to their businesses, with respect to their shareholders, their employees, and so on and so forth. And government stepped in and bailed them out, right? And so from there, the playbook is entrenched, right? I know that I can take on these excessive risks. I don't have to worry about managing my business or potential downturns, right? I have keeping enough cash on the balance sheet, right, to manage times of stress and things like that. And in doing so, I can take these excessive risks, and ultimately I know I can go to the government and get another handout when things go bad if they do. And so when you accelerate to 2019 and then into 2020, we started seeing the issues of the great financial crisis 10 years or so before become much more permeated, a larger footprint, essentially. And that footprint really went from the housing market issue like we had in 2008 and 2009 to a global asset class issue. We're seeing really inflated debt levels in the bond markets, in the housing markets, in consumer debt, in student loans, and the stock market was at all-time high valuations and all of this stuff. And it's because we're pumping so much money into the system, and that creates so much liquidity that it has to go somewhere. And so I mentioned the Cantillon effect earlier, right, where the people closest to the money creation are the ones that benefit. The biggest issue is we've seen inflation show up in assets. We haven't necessarily seen it show up in like consumer goods, like food and things like that every day, because technology has kept that stuff so low, right? We're able to produce that stuff so easily now. But it shows up in the scarce assets like stocks, like houses and things like that. And so what we've seen is when you introduce this much credit, that means you're introducing more people into a market that can buy these types of assets because they now have access to credit. And so that puts an upward force on the price of these assets. The problem, however, is when you're introducing this amount of money on this scale that's been unseen before in all of human history, it's going to flow into these assets, and 40 to 50% of Americans live paycheck to paycheck. They don't own assets, right? So the people that own assets, they're going to be the ones that benefit because the asset prices are going to rise, right? And the people that are living paycheck to paycheck, they never get an opportunity to go and buy those assets for less than they're valued because of what they've done. And so, like, if we don't do these bailouts, well, assets now come down to more reasonable valuations because the credit goes away, and the market participants that shouldn't have had access to that credit, they go away. And so now people have a better opportunity to buy these assets. And that's how capitalism proliferates. Everybody gets better off, and the wealth distribution is more spread out. But what we've seen since 1971 really is through the proliferation of credit, through the proliferation of bailouts, through the proliferation of injection of liquidity throughout literally the last 4 or 5 decades, the people that have owned assets, they've gotten wealthier over time. And the people that live paycheck to paycheck, they've seen the dollars that they're holding every day just to buy their normal goods and services, well, they're getting massively devalued, right? And so when we talk about wealth inequality in this country, the wealth inequality picked up in 1971 on an accelerated, almost exponential level, and has picked up steam all the way to today. And what are we seeing happen now? Billionaires got even better off, right, as a result of COVID-19, right? Since March, Bezos has gotten even wealthier, right? All these other billionaires have gotten even wealthier. And it's because they have direct access to this liquidity, right? They obviously create great companies and all this stuff, but the system is naturally incentivizing the people closest to the liquidity creation to be able to disproportionately benefit from that.
Okay, and that brings us into one of the next bullet points I want to talk about, which is rent seeking, and why rent seeking individuals and institutions, what impact rent seeking has on the economic system, and why, when you get asymmetry in the system, you have a totally different economic system when it comes to the production of value. So I guess firstly, let's define what rent seeking is and what it means for the average person economically.
Yeah, so rent seeking is where you initially need a third party to settle a transaction, right? So like a great example is a toll road or something like that, right? If I want to use a road, basically get on a road and then get off at a different location, right? I have to drive across that road, and there's a third party sitting there in a toll booth saying you have to pay to use this road, right? So that's like what a rent-seeking type of activity would look like. Where we see it proliferate in the financial system is with banks, right? So our money is ultimately our money, supposedly. But we have a financial system that's constructed where we have to deposit our money into banks, right? So if you work for someone, they deposit it into your checking account, your pay, right? And from there, you use your bank's checking account to send money wherever you need to, and you can take out debt against that if you want to, and there's different things you can do. But ultimately, your bank is the middle party to your entire financial process. And because of the way it's been constructed, banks can charge fees to you to maintain the account and do whatever they want to do, and they also charge all kinds of hidden fees to you that you don't even see. And this really comes about because of the information asymmetry that's present here, right? Banks are typically much more financially literate than the average person, so they can throw around different jargon. They can talk about all these new services they can give you, but it's ultimately just repackaging different types of products that have been around for ages in a way that they can milk you, right? And so when we talk about like interest rates are at all-time lows. The Fed fund rate is currently at 0%. So the cost of money is currently 0%, right? And we talked about what that means with respect to how valuable that money must be. But ultimately, we still have banks that charge 25% for a credit card, right? So things like that. And so what happens is because of that information asymmetry, because the banks are really the closest to the money creation, they are able to create more money as they need it when they make loans to people that they shouldn't be making, and those loans go bad. Instead of the banks having to recapitalize by raising capital or potentially going out of business, what happens? The Fed steps in and they fund them with additional liquidity. And so with respect to the rent seeking, they're able to use this lender of last resort, that is the Fed, to really leverage up these rent-seeking activities. And that's what gets the economy overheated in a lot of ways. And it's also ultimately what milks the everyday person from the value that they've rightfully accrued for themselves, right? And the biggest thing is when you're taking your dollars and you're putting it into the bank, when you log into your Wells Fargo account or whatever it is, and you see, oh, I have $10,000 in my checking account right now, all that really is a number on a screen, and it's an IOU. That money's not in your hand. You don't custody it, and you don't control it. So at any time, you're at the whims of that bank to be able to actually give you your money that is rightfully yours. But it's really just an IOU, because in the system that we have, the bank is turning around and taking that $10,000 that you've deposited, and they're lending it out. And they're lending it out right now at, they'll take that $10,000 and they can lend out up to $9,000 or potentially even more of your money to other people. And if they're doing bad lending practices or whatever it is, which is known, this system is known as fractional reserve banking. So when they start really expanding credit and giving it to people that aren't necessarily credit worthy for a lot of different reasons, right? What can happen is those loans can go bad, and now your deposits, well, they're no longer there anymore. That's just an IOU on a screen. And so we have a system that's completely credit based from that standpoint. So when we see prices across the economy and everything, that is the result of this credit expansion through fractional reserve banking. And they're able to charge all types of rent-seeking fees because they sit at the middle of the system, right?
Okay, and I guess that makes sense to me, but the reason, I guess the way that rent-seeking institutions have been described and why they're so damaging, potentially is that they don't actually create any value, right? It's that they're creating wealth out of essentially no production of any value. Now, obviously, they're providing a service usually that people need. Oftentimes that they don't even have a choice. I lived in Chile for a little bit when I worked at that startup I was telling you about, and Santiago is the wealthiest city in all of South America, and every single skyscraper in the city is a bank, right? Mm-hmm. And it's also one of the poorest places on the planet, Chile. It's like you literally have the rich bankers and you have everyone else who's just like insanely poor. Mm-hmm. And the interest rates were high, and the banking situation was corrupt as far as I was told, and it was a very predatory environment. Everything was expensive for poor people. It was really interesting to be in that situation where it was just so expensive to be a poor person. It was just so obvious to me how everyone just stayed poor, and all the bankers stayed rich. But I used to work in real estate, and one of the things that I always thought was just the most bizarre part of the whole transaction was dealing with title companies, because title companies, their function is so insanely mundane and simple that maybe it's just because I'm naive to the actual complexity of it, but the amount of money that is involved with real estate title is just absolutely mind-blowing. Yep. And the function that they provide just seems to be so incredibly simple. And I remember going to a continuing education class where they were talking about blockchain and cryptocurrency and how it may tie into the future of real estate transactions. And one thing was very clear is that a lot of people there were terrified. Well, a lot of people there that were in the title industry were very concerned that the decentralization of ledger technology was going to be very threatening to the entire industry of transferring title. Because a title company, all they do is they just ensure that when you're buying a house, that you actually get ownership of the house at the end of the day, and that the person who's selling you the house is entitled to own the house. They have they own it without any liens or anything, and they have clean ownership of the house, and that they can transfer you the house, and that's it. Really, it's like right. And it's like this huge industry that I thought was just so incredibly unnecessary to even be involved. And most of their people that work at the title industry, they they provide value in the form of everything not related to their actual job. It's just like I'm completely blown away that it's still a thing.
So what you're talking about there, if I may interrupt, is the need to trust, right? So whenever you're entering a transaction where the settlement isn't just a clean settlement where there's two people, right? And they need to be able to trust that the other person is going to give the consideration that they're saying they'll give. And then likewise, you're going to give the consideration that you're saying you'll give. Well, you often will bring in a third party intermediary that will ensure that that transaction actually takes place and settles, right? And so that's the need to trust a third party. So real estate's a great example. Financial transactions are a great example, right? Like when you want to send a payment and it takes 5 days, like a wire, it takes 5 days to settle, and they're going to charge you, like, let's say you're sending a $500 wire and they charge you $5 in fees, right? That's that rent seeking that's taking place because you need to trust them to be able to settle that on the back end for you. What these decentralized technologies allow is for the removal of the need to trust a third party, right? And third parties, when they come in and you have to trust them, a lot of times there is that information asymmetry where they can leverage the fact that they have certain knowledge that you don't against you and really, extract value from that transaction that they really don't need to. And so these decentralized technologies like a Bitcoin or, there's other smart contract platforms that are coming out where essentially you remove the need for third party trust to be in the middle of these transactions. So a smart contract is an example where you have certain conditions that you program into the contract, right? And it could be via a function of time and then via a function of like certain criteria that has to be evident, right? And then once those things are met, you don't have a third person that's going there and verifying it and saying, okay, give me my fee. And then, okay, this contract settles. The contract automatically does it itself, right? And that's the type of technology that we're moving toward. It really started to come on the scene with blockchain technology, which is, the first example was Bitcoin. But there's been a lot of new projects that have come along since then. One of the main players right now within the smart contract decentralized technology space would be your Ethereum platform. And there's a lot of development going on the platform. Ultimately, what it's going to allow for is decentralized applications. Just like so on your phone, you have all these applications that you can use. These applications will be decentralized in nature where the user owns their data. They can remain private if they want. They don't have to rely on third parties and trust third parties, right? And they can use these applications to facilitate payments like I just talked about or other transactions where traditionally third-party trust was necessary, but can now be replaced with these types of smart contracts like you were talking about.
Yeah, smart contracts is in my opinion the future of real estate transactions, but it all needs to start with people who are willing to engage in the process now as it's a young
Mm-hmm.
technology. I remember just a few years ago I heard about the first real estate transaction in Arizona that was done under the blockchain, and I was like, okay, what does that even mean? But really, it's pretty simple. It's like, okay, the transaction was uploaded into the blockchain, and it's now essentially public information. So now that when someone sells that house the next time,
Mm-hmm.
we know exactly who bought it and who sold it the last time, and that's as simple as that goes. And it's like any relevant information about that property is going to go into the blockchain, and it's going to get recorded, and everyone's going to be able to see it, and it's going to be like infused into the whole structure, the whole fabric of reality that the whole system works. So it's like this big web of integrated knowledge that's just like completely public information, as opposed to the old way of doing things, which was if someone buys a house, you go to the office where there's a library and a bunch of filing cabinets and a bunch of cards with the title of the property and who sold it, who sold it last, and who bought it last, and if there's a lien on the property, and it's like literally a card, like a physical paper that's in someone's filing cabinet. And if someone makes a mistake and like goes through and pulls out the wrong file, then the whole chain of events can be completely
Right.
corrupted. And then that's when, you have these cases where people buy property or sell other people's property. Right.
Mm-hmm.
And I guess, I was born in the 90s. So it's like the idea that would happen just seems completely ridiculous. And then when I learned about real estate, when I got my license, you realize about how common it was for real estate fraud to exist, because people would just sell things that weren't theirs. They would
Right.
they would buy things not knowing who they were actually buying it from. And me growing up in California in the 90s, it's like that I never heard about that happening, and I don't even think that really that was a huge problem, because the parcels of land that were bought in my neighborhood it was very obvious who was buying what and where the property was. But now,
Mm-hmm.
the the idea that you could that you could buy something that you could sell something that isn't yours. Blockchain essentially, it completely removes the possibility of that ever happening theoretically, right?
Yeah. It'll greatly reduce fraud. It'll greatly reduce administration costs, right? Like, so I mentioned earlier how bureaucracy is just driving up so much cost throughout society, right? Well, that's going to be greatly reduced through these types of efficient technologies. And you're absolutely right. Like blockchain, it comes with a lot of hype. It comes with a lot of unproven application, but the promise is certainly there. And the intellectual capital that is storming to this space is really something that's been unseen since the mass migration to Silicon Valley in the 1990s and early 2000s. People are leaving Wall Street to go and work in these blockchain companies in the blockchain space. People are leaving Silicon Valley companies to go start blockchain companies. A lot of these are Bitcoin companies and things like that. And ultimately, like we get back to real quick that third-party rent sinking and the ability to remove people that just weigh down the actual value transfer, right? They extract costs that shouldn't be extracted from that transfer. Bitcoin allows you to, right now, if I wanted to, send hundreds of millions of dollars from here to Japan. It'll settle in a matter of minutes, in under 30 minutes probably. And it'll cost me a few dollars maybe to send $100 million in value anywhere in the world I want, without the need for any intermediary, without the need for any bank to tell me that I'm allowed to do this with my money. And it allows me to remain private to the point where I decide that I want to actually reveal myself in the transaction. That is completely revolutionary. And that doesn't even take into account all the sound money types of properties like we talked about before. It's still a very young technology. The technology needs to continue to develop in order for it to scale to where people are using it every day. But I like to think about the base chain for Bitcoin as something where it's going to be only used where when people need to transfer large amounts of value, where they're willing to pay a slightly larger fee in order to get their transaction on the base layer. Because from that, there's all this development going on in the space where there's second layer solutions where you can think of something like a Visa or PayPal that's going to allow for micro payments and things like that to proliferate on the Bitcoin blockchain without actually needing to use the Bitcoin blockchain for each individual transaction. And that's getting a little bit more technical. But my point here is the technology is still very young. It is in nowhere near finished, and it's certainly not ready for mass economic use today. But it definitely provides value to people that need it right now. And like a great example that I love to use with people is, you go back to something like Nazi Germany, okay? And if you were Jewish in Nazi Germany and you saw what was happening, you knew that you needed to get out of there, okay? And in the 1920s, if you had a house and well stored up and all this stuff, but you knew you needed to leave, the way you were going to do that was to sell everything for gold, okay? And so you're going to have a big bag of gold, and you're now going to go and try and travel, thousands to tens of thousands of miles across the world through extreme political boundaries and that posed a massive risk where you would get stopped at a border or on a train, and you'd have your entire life savings in your bag of gold, right? And that would be potentially confiscated from you. And you take that example and you can extrapolate that to today, right? People need to leave their respective countries for a number of political reasons, and they used to do so through that gold example. Well, now you have something like Bitcoin, where all you need is an access to the internet, and all you need is potentially a thumb drive. And as long as you have the private keys, which is basically your password to that wallet that holds all that wealth, well, no one will know you have it. No one can confiscate it from you. And that's yours. There's no third party risk there. There's no counterparty risk where it's an IOU, like where your dollars are in a bank and you have to go get that money from the bank. That's money in your hand that you know for sure will always be your money, unless you decide that you want to either forget you have it or, transact it to someone else. It's extremely powerful outside the lens of the U.S. experience that in this country. We might someday. It could happen here. But this is a global phenomenon that's taking place here. And it's extremely valuable for the everyday person that faces extreme political pressures, right? So I'm very passionate about it for that reason.
Okay, so Bitcoin offers this sort of this decentralized freedom of being. It's almost it could potentially be like a safeguard from being taken advantage of, right? That being said,
and governments do it all the time, by the way. Real quick, sorry to interrupt you there.
No worries.
But in 1933, so people don't even realize this about our own country. In 1933, President Roosevelt signed an executive order that outlawed the private ownership of gold for U.S. citizens and forced U.S. citizens to turn in their gold savings for a price significantly less than the market rate in the name of national security. So these things have happened even in this country before, where your wealth, your government could decide that wealth isn't your wealth anymore. And so something like Bitcoin allows you to save your wealth outside of systems where we have potentially predatory governments coming for it. So,
okay, yeah, I mean that's pretty terrifying to think about happening in our country, because we like to believe that we live in we like to believe that the government that we elect would never do something like that.
Right.
But who knows, man? I mean, as far as I'm concerned, anything is possible.
So, it's 2020, right? A year ago, if I told you that you were going to be wearing a mask pretty much everywhere you go, and one of the most repeated lines you'd be regurgitating throughout the year would be, "Oh, I forgot my mask. I got to run back in the house real quick to grab it." You would have been like, "What are you talking about?" Right? So, yeah. I mean, these things are certainly possible, and they've happened before in human history. And human history doesn't necessarily repeat itself, but it operates in cycles. It rhymes, right?
Yeah. So I want to get back to the, I'm very, very, very interested in how Bitcoin and the blockchain and decentralization as a whole, because decentralization doesn't just pertain to currency. I mean, it pertains to like all sorts of stuff. The decentralization of whatever it is can perhaps be a strengthening factor in the stability of a system, right? The decentralization of power, right? The decentralization of the internet, right? It's like all these things when you no longer render it liable to the poor decisions of a small few, it provides a more robust system. That being said, blockchain and cryptocurrency is not a worldwide, globally adopted mechanism of transferring value yet, and it's volatile as a form of value right now. So Bitcoin is not a stable. Right. It's not a stable form of value. I don't feel confident putting my money into a lot of cryptocurrency right now, because it's just completely completely unpredictable. It's very volatile, and I'm just not really like everybody. I don't want to put too much value in a place that has that amount of volatility. So my question is, why is Bitcoin so volatile? Even though it's been around for it's been around for a while at this point, but it's still very volatile. Yeah. Why is it so volatile, and what needs to happen in order for it to be no longer so volatile?
Right. So it's funny because Bitcoin is a little over 10 years old now, right? And it has around $200 billion in value in the network. That's like the market cap, if that's how you want to explain it. And so never before in human history have we seen an asset go from $0 to $200 billion in the span of 10 years. So that volatility, right, it works both ways. It works to the downside, but it's also something that gives you tremendous upside potential. And while Bitcoin is 10 or 11 years old, we have to frame this with respect to the market that it exists in, which is the free market for money, right? And money underlies everything that we do in terms of the decisions that we make, right? And how we relate to each other and all that stuff we talked about. And this is a global asset. So it's not just within the lens of a US citizen, right? This is within the lens of all the citizens of the world that have access to the internet. That's the total addressable market for Bitcoin, potentially 7-8 billion people, whatever the amount of people there are these days. And so it's still very young. It's a nascent asset. It's like I mentioned, the technology is still developing. The pace of innovation is there. It's going where I believe it needs to go. And then the pace of adoption is there as well. So when we think about volatility, we have to think about volatility with respect to how old the asset is itself. So a great example I like to use with people is internet stocks back in the early 1990s, and then all the way through the early 2000s. So we got this .com bubble that culminated really in a busting right around year 2000 or so. And prior to that, the internet was just newly forming. It was still very nascent, right? We didn't even have internet browsers or anything like that prior to like 1995. And then Netscape came along, and that really opened up the hatchet for this significant proliferation of internet businesses and applications on the internet, right? But prior to that, the internet stocks were extremely volatile, and they were also volatile through the 90s and then into the 2000s, right? So Amazon's a great example. Amazon crashed about 95% or so during the .com bust. I think it's over 90%. Directionally, I'm correct. Don't quote me on the exact percentage, but this thing lost almost all of its value, right? But it eventually, because it wasn't mature yet, it hadn't become the business that we see it as, 20 years later, right? And so very early on in the adoption curve for something like the internet, we saw extreme volatility. And right now what we're seeing is Bitcoin's still extremely early in its adoption curve. It only has probably around 100 million to 200 million people that have adopted Bitcoin at this point, which is, in a 10-year span, that is an incredible number of people, right, in terms of the growth, right? And that's why we've seen it go from $0 to $200 billion. But with respect to its addressable market, this thing is still a fraction of the overall potential that it could end up leading to. So it's volatile right now because people are still adopting it at its nascent age. And as more and more people adopt it, the usage of the network will continue to explode. And if the usage explodes with that adoption, the value will continue to go up, just like any network effect, right? You have one telephone, it's useless by itself, but you add a second telephone to it. Well, now we can call each other and that network's more valuable. And then you add more and more telephones to it, and that network becomes infinitely more valuable as people join the network, right? The same thing with Bitcoin right now. It's very, very small in terms of its adoption with respect to its potential adoption. So right now it's going to be volatile, and that volatility, so long as the innovation continues and so long as the pace of adoption continues, we're going to see that volatility on a net basis rise to the upside, which is good because ultimately what this is these are people saying this is a better form of money. It's not perfect yet, but it'll get to a point where we can use this daily. And the reward for adopting it early and people speculating on people wanting to use it later on is that upside volatility. So right now, like you said, I would never tell anyone hey, you should just save in Bitcoin. right? Because you need to have something that can be a little bit more stable with respect to prices, so you can perform economic calculations in your daily life. But what I would tell people is that I think it's irresponsible to ignore something like this and have a 0% allocation, right? You should 100% be doing your research, looking into this stuff, and then determining what makes the most sense for you in terms of your position size, if this is something you do decide you want to buy. Because let's say that you have an overall portfolio and you go, okay, I think 2% is an okay allocation, right? If you lose 2% of your overall portfolio, okay, well, you still have 98% of it left, right? So not so bad. But that 2% could be a 10x or 20x over the next 10 years. And now 2% of your portfolio is really 20 or 40% of your overall portfolio. And so it's all about assessing that risk at an individual level, understanding what kind of uses you could see Bitcoin having for you in the future, whether it's protecting yourself from currency debasements or some of those other examples we talked about with needing to be able to transport it and store your wealth outside of government control and all that stuff, right? However you decide that Bitcoin is valuable to you, I would tell you that the bigger risk right now is looking at Bitcoin, doing research, and then not allocating a certain portion of your wealth to it, versus and then having that wealth go really high, right? And then Bitcoin just taking off. Like if you were to miss that, versus okay, I put 1 or 2% in and it goes to $0. Well, hey, I would have gone and spent that $500 on a new pair of shoes and maybe like a purse or something. And guess what? That money was going to go to zero anyway. And you probably weren't going to be using those shoes 6 months to a year or so from now anyway. So what I tell people is think about your future, not just the present, and think about the impact that something like this could have on you 10 years from now, 15 years from now. Because it's a very binary proposition. Bitcoin is either going to become something that people are using on a global scale frequently and in everyday life, or it's probably going to go to zero eventually. I believe that in the next 2-3 years, we're going to see some significant upside, and I'm positioned appropriately.
Yeah. So what you're saying is it whatever it's at now, and however volatile it is now, the downside is very, very limited and concrete. It's at whatever it's at. I haven't checked it in a couple of days, but it's at whatever it is now, and it has been higher, right? It went up to around 20,000 a coin, and then it went down significantly. But what you're saying is that the potential upside for Bitcoin, if and only if it has sustained increase in adoption, then it has the potential to go insanely high. So the upside is really, really, really high when it comes to Bitcoin and other coins for that matter.
And by the way, so there's ways to assess that adoption, right? The adoption curve for Bitcoin has only gone up year over year, regardless of the price. So you can think of the price like a drunk person walking a dog, right? So it's going to be a lot like this, and they're kind of going to be going like that, but they're going to stay along that kind of adoption curve and come back to the mean a little bit. So when you saw the price get way ahead of the actual functionality of the network and the actual value of the network, like when it ran up to 20K for a couple of days, and then it proceeded to go back down to, I think, like 3,100, right? And people are going, oh, it's dead. It must be dead. Look at that. It just lost 85% of its value. Well, I would argue that shows how resilient it is, because ultimately it bottomed and it's now up to, I think, $11,700 or so, whatever the number is. And year to date, 2020, it has outperformed the broad stock market. It's outperformed the S&P 500. It's outperformed the NASDAQ, and it's outperformed gold, because the market is determining right now what the hardest asset is to be in these types of inflationary times that we find ourselves in. And the market is saying, I want Bitcoin. And I don't know if that's going to continue, but what I have seen is Bitcoin has outperformed every asset out there, I think, in like something like 7 out of the 9 or 7 out of the last 10 years across markets. And I'm going to keep playing those odds, and I'm going to do so by position sizing accordingly, right? This isn't something where you want to have a stop loss, right? Where it's, hey, if it drops 50%, I'm out. No, because that volatility is your friend. You want to let that volatility come. And there's going to be a lot of volatility along the way from here. There's going to be more 50% drops. But I promise you, or at least I believe, we're also going to see significant upside. And so that volatility can be your friend if you know how to play it and manage your risk appropriately.
Okay, and also, I think it's easy to view Bitcoin and the price of Bitcoin and other cryptocurrency, other coins. I think it's easy to kind of view it almost as if it's a stock, almost as if it's kind of like a business. Is it useful to look at Bitcoin kind of like a business as opposed to a currency because of just because of the way that it's used? I mean, even though it's not a business, obviously it doesn't have. No one owns shares of. No one owns equity in the company Bitcoin, but people own parts of it, and so it's like when I first started investing in crypto, I kind of looked at it like I was just sort of buying and selling stocks. Yeah. And what's the most useful way to look at it? Because I don't do forex. I don't invest in foreign currency. I know people who do that trading, and I don't understand. I don't understand it at all. I don't understand why people take the positions that they do and how the money's made. But you're saying that the volatility the volatility is good, but then there's people who they like to try to time the market, almost like trade it intelligently, and
in my opinion,
well, right. And there's a lot of scams that have emerged out of the idea that you could potentially use algorithmic trading and stuff like that to kind of have reliable returns on really small and fast crypto investments. Is that even a thing? Because I don't know if you're aware, but recently in Scottsdale, there was sort of a Bitcoin Ponzi scheme that was busted, and it was I actually was sort of acquaintances with some people that were involved, and it was a big, really, really, really interesting thing. That there's going to be documentaries made about it. These guys were taking money from professional baseball players and claiming to provide 25% returns, and they were dishing out these returns, but they were just using the money that was coming in from other investors, and eventually they ended up. It turned out that it was like somewhere around like $20 million that they just stole and spent, and no one's getting their money back. And what I learned from that was that there's a lot of Bitcoin Ponzi schemes all over the country, all over the world that are happening because of people who claim to have information that other people don't regarding the crypto market. Now, is that how does that work, and how can that work?
So I think what you're asking is, are Ponzi schemes more prevalent in the crypto market than elsewhere, and how is that a problem potentially?
Yeah, well, is it even possible? Because there is such things. There are people who can use certain algorithms and quants and stuff like that can actually manipulate the market, the stock market. But I guess what I'm asking you is, does the cryptocurrency ecosystem prevent people from manipulating it with technology like they're sort of able to do with the stock market? Because because there's some stability issues there.
Right. So if you're promising outsized gains, which is what a Ponzi scheme is, I'm going to guarantee you these gains, and they're going to be significantly higher than you would expect in a market, right? Those are typical red flags, and they proliferate in any market. It's not just cryptocurrency, right? If you're going to be scamming people in crypto, the typical types of scams we see is, hey, I'm going to hand out 0.5 Bitcoin for to every person that sends me 0.25 Bitcoin first, and then I'll send the 0.5 back.
Are you talking about the
stuff
Twitter
like
hack?
That happen. The Ponzi's. Oh yeah, that's one of them. But these types of scams have been going on for years and years. But yes, the Twitter hack was very, very prevalent. And it's one of those things where people go, oh my gosh, Bitcoin's used for illicit activities. And I take a pause back and I go, well, the biggest thing that's used for illicit activities out there is the US dollar. Like we see all these money laundering scams that happen with the biggest banks in the world, and they get slapped with these fines, which essentially amount to the cost of doing business. We've seen where banks have been caught red-handed money laundering for cartels, money laundering like in the Asia Pacific countries. I think HSBC, you don't quote me on the specific bank, but I believe it was HSBC just settled this, what was it? I think it was in Kuala Lumpur, this massive money laundering lawsuit that occurred there. And so the US dollar ultimately facilitates all types of illicit activities, right? People use it to trade for drugs and things like that, right? Because it's private and cash. And so you'll see this across any asset class where people can get clever and try to deceive other people. Within cryptocurrency, you can at least get down to, like, you can go and verify on the blockchain all the transactions that are happening. So if someone's telling you, I have this trading scheme and I do it on this blockchain, and it allows me to produce these gains based on an algorithm or whatever, right? You can go in and verify that if you need to. And if they're telling you that, oh, no, it's like some other way, well, then you can go and investigate that, right? So these schemes, they're always going to proliferate wherever there's new technology, wherever there's a new emerging market, wherever there's big opportunity, right? Like, so when there's gold bull markets, what happens? You see all these people coming out of the woodwork going, we buy gold, right? Send us your gold, sell us your gold, right? For like whatever it is, jewelry, like we'll buy it. And they basically just try to lowball you, and they'll try to get your gold that's worth $2,000 today. They'll be like, oh yeah, I'll buy that ounce for $1,500. And, unsuspecting people don't realize that they're basically getting taken for a ride. So that stuff happens pretty much no matter what asset class you're looking at. There definitely are a proliferation of scams in the cryptocurrency market simply because it's a truly free market, right? It's not truly regulated like the traditional stock market is or something like that. And so you're not going to have as much government oversight, but there's trade-offs to that. It also means that you get to act freely and you're responsible and accountable for the decisions you make within that market, right? So you also asked about the Bitcoin, how you should approach considering it. Like, is it a stock or is it a business or something like that, right? And I love those questions because ultimately how I answer it is Bitcoin is whatever the user needs it to be for them, right? It can be a store of value for a person, right? Like if they need to get out of a country, like I mentioned, they can put their money in Bitcoin and get out of there, right? It could be a means of payment, right? So I could literally go pay for coffee if I wanted to. It wouldn't be super efficient right now to do that, but I could use it as a payment mechanism if I wanted to, right? I could even use it as a unit of account. I could go out there and I could say, hey, my house, I'll sell my house to you right now for 20 Bitcoin, right? And eventually, as it does mature, I believe that's where it will go. So first and foremost, for money to get to the type of use that we see with the unit of account, like we use for the US dollar, it first and foremost needs to establish that it's a store of value. And so the narrative right now shows that Bitcoin is gold 2.0. Right now, it's acting like an inflation hedge against all of these things that we've talked about with our traditional financial system. After being a storage of value, it then becomes a medium of exchange, right? So once people determine that it has value, well, now we can actually exchange it with other people for goods and services and facilitate trade. And then what ultimately comes from that, once we reach that stage, is further maturity to the point where price does become more stable because more and more people have adopted it over time. And now we can start using it as a unit of account for goods to facilitate trade, right? So what I tell people when they're approaching this asset, I tell them, what do you want to get out of the asset? Have you studied it? Do you understand the properties that people think make it value? And then ultimately, how is that valuable for you? And that's how I think you should approach using and interacting with the network.
Okay, yeah. So you're again. This kind of brings us back to the necessity is the mother of invention, and there are some use cases where Bitcoin is just actually a more effective and a more efficient mode of transferring money. I mean, I know companies who were thinking about paying their employees that lived in other countries with Bitcoin because it was actually it was like a real serious conversation.
Yep.
And things like that. And I think as more companies start to contract out remote gig workers and stuff like that, it's gonna have more of a common use case, and then that will bring on more adoption. But I guess the thing that I've always been kind of concerned about is, like, how are you going to get massive adoption when you have volatility, right?
Mm-hmm.
Because the reason why I'm not buying stuff in Bitcoin is because it's like, well, I can buy stuff with dollars, and buying stuff with Bitcoin just adds sort of like an unnecessary risk, I suppose, with the types of currency that I actually own.
Mm-hmm.
So I in the same way that when Uber launches in a new city, it needs to understand that. Well, one thing that was really interesting was learning about how Uber and Lyft, how they gain adoption in the new cities that they come into, especially with all the forces working against them. Right, you have like the taxis that don't want them there. In Chile, there was taxi cab drivers that were like beating the shit out of Uber drivers because there was a serious like moral problem with being an Uber driver and adopting this new technology, even though it helped a lot of people, and it helped people it helped people provide an income for their family without having to go and spend like $100,000 or something like that on a taxi cab license and go through all those different processes in order to do that for a living. And you have to have the perfect amount of, well, not really a perfect, but you have to have a compatible amount of drivers and a compatible amount of people using the app to get rides, or else it just won't work, right? If too many drivers, then you have the drivers aren't making any money and they're not going to do it. And if you have too many riders, then none of the riders are going to be able to get a ride, and they're going to stop using the app. So you need to have this perfect kind of lockstep progression, where it's and it's very complicated. There's a lot of things that can go wrong. So to me, it's no surprise that blockchain, that crypto as a form of payment and a form of wealth storage is having a hard time catching on, because there's just so many reasons for people to not do it. But in order for it to stop being so volatile, people need to adopt it more widespread, right?
So yeah, and so to that point, right, the way that the network is designed at the protocol level is you have incentive mechanisms in place to bring new people into that adoption curve. And so the way I explain it to people is, right now, today, if you had bought Bitcoin at any point in time, and this is metrics that you can evaluate on the chain. There's some great companies out there that do this stuff, but I think it's anywhere from 90 to 95% of the people that have purchased Bitcoin are in profit right now. And so the true, right now at this nascent stage, and this gets back to any money, right? When people are choosing money, it's subjective value. And that subjective value first and foremost starts with, can I potentially store wealth in this good based on its monetary properties? And will I eventually be able to exchange this good with other people, not just today, but in the future, based on its potential adoption curve? And we've seen Bitcoin's adoption curve be unrivaled with any other asset in all of its history, both from a price standpoint, from people that come into the network and actually buy and hold Bitcoin. So right now, we are at all-time highs in terms of the amount of Bitcoin supply as a percentage of people that have held Bitcoin for more than a year. It's something like 62 to 65% right now. So that shows conviction in the people that are in the network, that more and more people, they're not trying to sell their Bitcoin right now, because they believe it's a true store of value, and they believe more and more people are going to come to the network, because the way that human nature works, when you see that number going up, that makes people want to come and buy, because they want to get a part of that bull market, right? And so as the number goes up, more and more people come to the network and adopt. And one of the things that makes those numbers go up is obviously that adoption of more people, but also the dynamics of the actual protocol level with respect to supply. So you talked about the halving before, right? So every 4 years, there's a programmatic halving that occurs. And essentially what this means is there's going to only be 21 million Bitcoin that ever exist, right? Right now, we're like at 18.5 million or so, directionally correct, not exact. And how we're going to get to 21 million is there's every 10 minutes, a new block gets mined, and that block has a reward of, I think it's 6.25 Bitcoin now. So back in May of 2020, so a few months ago, Bitcoin experienced a halving. And again, this halving happens every 4 years. So I believe this was the third Bitcoin halving, if I do that math correctly. Don't check me on that. I think it's the third. It might be the fourth. But essentially, every 4 years, this halving occurs. And what it does is it halves the rate of new introduction of Bitcoin into the market, right? So essentially, the inflation rate, right?
It's slowing it down.
Exactly. So right now in May 2020, the new supply of Bitcoin in the market got cut in half. So if you hold demand constant, right, and you're now saying there's only half of the amount of Bitcoin coming to meet that demand, well, simple supply and demand theory works that this price has to raise. And so every 4 years, Satoshi Nakamoto programmed into the protocol of the network for this naturally price upward pressure to come to the network because of the supply getting halved every 4 years. So prior to May, we had 12.5 Bitcoin every 10 minutes getting introduced into the network, and now it's like 6.25 or something at that point that the halving occurred. And you do hold demand constant, the price has to rise. So, but if you have this situation where central banks are printing all this money and people are saying, well, I need to get gold to protect myself from currency devaluation. And people are also hearing this narrative about how Bitcoin will also protect against that. So if you're not just holding demand constant, but you're now introducing new market participants along with a programmatic supply shock, well, you have extreme potential for upward price pressure on the network. And it's my opinion that's what we're seeing today. So I sent you a note, I think last week. I look at some with respect to different assets. So I'll try to keep it like a high level. But what we saw was the gold market, right? The price of gold. It closed this past month on July 31st. That monthly candle closure was the highest price that gold has ever been. For Bitcoin, it was the second highest. The only other highest time was December 2017, I believe. And so Bitcoin is currently experiencing, from a technical level and from a macro backdrop level and from a pace of adoption level, some serious tailwinds that could potentially propel the price forward. And so I look at these things, I look at other metrics, and this is something where it's worth a smart speculation, in my opinion, which is, obviously why we're talking about it here.
This makes me want to go buy more Bitcoin.
And, you just got to have a high time horizon for these things. You don't go all in. So what I love to tell people is Bitcoin is not a get rich quick scheme. Bitcoin is a don't get poor slowly scheme, right? It's a don't let your value get debased slowly by things that are outside of your control.
Like inflation.
Yes. Bitcoin battles that. And so if US dollars are becoming abundant, and the head of the Minneapolis Fed, he was on a 60-minute interview in the last few months during all of this when we were printing those trillions of dollars. And people were very worried about, is there going to be enough money to go around for people to pay their bills and all that stuff, right? Basically, is there enough liquidity in the economy? And the head of the Fed, of the Minneapolis Fed, literally said there is unlimited amounts of liquidity or dollars. And I'm paraphrasing, but he said there are unlimited amounts of money available. And so they openly admit that the US dollar is not scarce. It's abundant, right? And that is cause for concern. for someone that understands the history of money and what happens when the cost of money goes to zero, and we're able to just create as much of it as we think we need to at any time. This has played out across countries throughout recent history and throughout further history, and it ends the same way every time. It ends in societal instability and economic disaster and things of that nature. And I'm not necessarily saying that's going to happen here, but in 2018 and 2019, early 2019, the risk of this potentially happening was far, far lower than it is where we're sitting today.
Okay. Yeah, this is it's alarming. I would say this is a bit alarming. But I think that it's safe to say that confronting this problem is probably the best thing that we could do as a society, even though it's like ripping off a Band-Aid. Mm-hmm. It sounds like what we're doing is we're avoiding the phone call from our doctor that we have, like our CAT scan came back a little weird, and mm-hmm. we're just sort of like putting it off. But the truth is the truth. Mm-hmm.
Yeah. And to your point, I don't think the Fed is this collection of evil people, right? I think a lot of them there think that they're doing what's right for society, right? They know that, so when unemployment rises like it has, people die, right? Like for percentage rises in unemployment like we're seeing, we're talking about potentially tens of thousands of people dying because that means people can't feed themselves. They can't pay for their rent and all that stuff, right? Severe economic instability leads to severe societal instability. And so the Fed probably thinks, and our government probably thinks in a lot of ways that, we're making that long-term trade-off to, keep people from getting really, really hurt. And I completely understand that. And it's not a position I'd ever want to find myself in, having to make those decisions. But the reality is these types of decisions do come with trade-offs. And if we're going to address the short-term potential pains, there's probably going to be more long-term pains on the horizon.
Yeah. I think it was Peter Schiff that was talking about, why we need to let a lot of these companies die and not be afraid of the short-term fallout, because we're, mm-hmm. Because it is going to hurt and it's going to cause some turmoil. And he was saying that this avoidance of short-term turmoil is it's understandable, but it's also sort of reckless. And he's also like he's a hardcore libertarian, and he believes that the government's gotten bloated beyond all repair. And it's really interesting. And he's also very, very, very he's very smart when it comes to explaining economics to like the sort of the normal person. Are you familiar with the guy?
Yeah, he's a huge gold bug, and he definitely understands the problems with the financial system, the problems with, interventionist measures that our government will take, right? And not just the first order effects of those types of measures, but the second and third order effects, the unintended consequences that we can't necessarily see on the horizon, right? That come much later. I definitely agree with a lot of the things that he thinks about that. And he's actually a huge gold bug too. Yeah.
What does he think about crypto? I mean, I'm not sure, but you were saying that crypto is becoming more and more seen as like a hedge against value devaluing. Yeah. Why not just use gold or silver? What's the? Mm-hmm. I mean, because those are definitely not going to be volatile anytime soon. I mean, I think it's safe to say that the value of gold and silver is not going to change very much. So that's a safe hedge. Mm-hmm. Crypto, it just doesn't seem like a safe hedge for me because of the fact that it can go to zero, but the upside is so much more than gold.
Mm-hmm. Yeah, so that's why you would allocate accordingly, right? You would put a bigger allocation toward gold if you're afraid of that downside volatility than you would for Bitcoin, right? Peter Schiff, he's not a fan of Bitcoin. He actually discovered Bitcoin, like I believe in the early 2010s. He had a chance to buy it when it was like less than $100, I think. And he continues to say it's going to go to zero, despite the fact that he's seen it rise from, the $1,000 range all the way up to $20,000. And we're sitting at just under 12 grand right now, I think. And he is an older person, right? So there's all these great studies that have been done. And essentially, the boomer generation, they understand the gold narrative a lot better than the millennials and the Gen Zers, right? And so there's all these studies that have shown that, the older you are, the more you're going to take a liking to something like gold, and also the less technologically inclined you're going to be, right? But the younger that you get, it shows that a significant percentage of millennials are already invested in crypto and are considering investing as well right now. And an even bigger percentage of Gen Zers are already invested and considering investing right now. And so we see this demographics trend play out. And economics is ultimately a function of demographics, right? We have older baby boomers that eventually are going to age, and they're eventually going to pass away, and they possess a lot of the wealth of our society. And that wealth is going to get transferred over the next 10 to 15 years. And that's going to get transferred in the hands of millennials and Gen Zers. And if they're allocating a significantly higher percentage towards these things than baby boomers did, well, you can kind of start to see that macro trend playing out in real time. So that's something, again, that also excites me.
So this wave of more risky, more bold investments coming as wealth gets passed on to younger people, you think that's going to be a good thing?
So risk is a function of perception, in my opinion. You can never truly know the risk until hindsight, right? I would argue that gold possesses significant risk compared to Bitcoin that Bitcoin doesn't have, and Bitcoin possesses significant risk compared to gold that gold doesn't have. And it's based on those properties. So we live in this currency system that we live in today with the US dollar because gold was confiscatable, right? It could be hoarded by central banks. It could be taken. It could be stored very easily in terms of being able to capture it, right? And for that reason, gold was co-opted. We had a gold standard in this country prior to we even having, like, the US dollar used to be a gold coin. And then it became gold stored in vaults and banks where they'd issue paper notes that were redeemable for the gold. And then it became, these paper notes are now US tender and backed by the full faith and credit of the government, and they're no longer redeemable for gold. So gold had its shot in a way to be the center of the financial universe, right? And it was clearly co-opted by governments to the point where we're using paper now as our means for economic calculation and exchange. And so Bitcoin cannot be confiscated in that way. So if Bitcoin does start to mature, if the network adoption gets to a point where it's maybe 1 billion people, that price volatility is going to be significantly lower. And it's also the strongest computing network the world has ever seen today. It has the highest hash power of any computing network that's ever existed. It's never been hacked. Its downtime over its 11-year existence or so has cumulatively been about a day or two at most, which is unheard of for a computing network. So I just believe that risk is nuanced, and I don't think there's an absolute answer here in terms of risk. I think that you should have an allocation to both things, and I do. And that's how I like to kind of approach this.
Okay, so you're saying, and I have some things that I have some bold questions that I want to ask you.
Okay.
What do you think about the long-term security of digital assets in the form of cryptocurrency when it comes to the potential offenses that could be coming down the pipe?
Yeah, definitely. So this is something that I've definitely looked at before, heard it across different conversations. And the way you have to think about this is quantum computing 100% would be able to hack a blockchain right now. But the thing is that quantum computer, it doesn't exist right now. And the type of quantum computing we're talking about to where it could be deployed probably won't exist for 5 to 10 years. But by the time that does exist, the encryption technology will also be accelerating at the same rates of the quantum computing technology, right? And so it's kind of like one of those things where the technology keeps up with itself, right? So as computing power technology advances, the attacks that you can advance with that computing power are going to be exponential. But the defenses that you can act with that computing power are also going to be there. So that's one of those things where, like, I don't concern myself with that, because I trust that the technology is going to continue to progress to the point where those things are going to be addressed over time. And that's certainly an unknown. And you can say that's a risk. I wouldn't argue against that potentially being a risk. I don't know how you quantify that risk right now. And I don't think it's a risk that someone should spend too much time on, because there's so many variables right now that we just don't know. And it's like anything else where people are like, oh, well, if there's an attacker here, how are you going to get rid of that? It's human ingenuity, really. Like, human ingenuity is going to keep up with this. So, like, the quantum computing thing is a very real thing. It's going to be here in the next 10 years, I think. It's definitely going to render a lot of our processes obsolete. There's going to be a huge cybersecurity implications for that. But I don't think that this is something where the blockchain isn't going to keep up, because it's all about that pace of innovation again, right? So, like, these things don't exist in vacuums, where the Bitcoin blockchain is going to look like it does today 10 years from now.
Okay, yeah, that's something that, you know, it's obviously a thing that needs to be kind of paired with my question is, okay, the advance in computing power is coming, but the advance in encryption is also probably going to come as well.
Right.
So,
and there could be, like, new encryption methods that develop, right, that are able to prevent a quantum computer from being able to attack that type of new encryption, right? And that would eventually get implemented into these blockchains. And the smartest people in the world are programming on these blockchains right now. And I know that they're thinking about these types of things. I have no idea how it's going to, like, develop, but it's just not something that keeps me up at night right now.
Okay, well, that's good. I guess the way I'm approaching this situation is, you know, when you think about you know, geopolitical national defense, right? You have the reason why we don't have superpower wars anymore is because of a thing called mutually assured destruction. It's not because we have really, really good missile defenses, though, right? It's actually completely irrelevant to our defenses to another person's offenses. Our defenses are effectively useless to the offenses that other countries have. So, you know, like the idea of nuclear deterrence, the idea that one country could defend against a nuclear attack from another, it's not predicated on its defenses, it's predicated on its offenses, and it's the only reason why it doesn't happen, because the defenses are nowhere near where they need to be in order to be effective at dealing with offenses. And it's also the same with biosecurity and obviously pandemics, right? Our defenses against something like a pandemic are also essentially, I mean, it's like nothing right now. We have ways of managing it, but we have absolutely no way of containing a pandemic at this point. I mean, the world has proven that in this moment, we had absolutely zero defenses, effective defenses from COVID-19. And maybe we will later. Maybe the next outbreak will be like a, no problem. I mean, probably not, but
it could be worse.
Yeah.
Could be a worse virus next time, right?
Well, it's sure. I mean, I would imagine it almost certainly will be, because COVID-19 is a really not that bad of a virus,
Right.
considering how bad viruses can get.
Mm-hmm.
And I this asymmetry between offenses and defenses to breaches to the system, is encryption just always going to be ahead of the ability to hack the encryption?
That's the $1 million question, right? It's kind of like the example I was going to allude to earlier is like the regulators and the bad actors, right? So the regulators catch up to the bad actors, but then the bad actors just figure out a different way, right? And I like to think of that as encryption in this example, right? So people are trying to figure out a way to break encryption, like governments all around the world, they're trying to outlaw encryption and things like that because they don't want their citizens to have access to privacy under the story of terrorist activities or anti-money laundering activities and things like that, right? And so the way I look at it is, I think encryption is going to continue to outpace the attacks on the encryption technology, mainly because of the human ingenuity involved with it, right? There are humans all over the world that care deeply about, liberty and privacy and things of that nature. And so there are people that are heavily invested in ensuring that these types of technologies continue to exist and proliferate in order to protect our privacy against, bad actors, whether it be governments trying to spy on their citizens or, whatever it might be.
Okay, so what you're saying is that our desire for protection against bad actors is much more powerful than our desire to, attack another person or steal another person's stuff.
Yeah, attack another person's privacy, essentially, right? Or other person's value in that case. Yeah, that's how I look at it, and I think that's true, and we're seeing that play out in real time, right? Like Bitcoin was essentially created from that type of incentive theory, right? So I just think that there are a lot more people out there that care about doing the right types of things than the types of people that are out there that want to produce technologies to do the wrong types of things, right? And I'm not saying computing, quantum computing is bad technology. Technology by itself is neither good nor bad. It's all about how it's used, right? It's a tool, essentially. So,
okay, I want to hit on the one last topic, which is individual privacy and data. So you touched on anti-money laundering, and that's also tied into the know your customer type stuff, and making sure that it's almost like it's kind of the similar to the title industry talk, where it's this confirming identities. It's confirming that
right.
that people are who they say that they are, and that their business is legitimate, right? And what that does is it requires us to give up certain pieces of information. I mean, to an absurd level. If you want to order an item on the internet, you have to give them your address, or you can't get the item. Now this person has your address, and now they can send you postcards to try and sell you more shit, right? And that's normal to us. And now what's becoming more and more normal is being retargeted ads because of things that you bought or things that you looked at. I go watch a YouTube video, and all of a sudden now my email is trying to get me to buy, a thing that's related to a YouTube video that I watched. So my data is being constantly monitored, constantly used to try and sell me stuff. Now, what I always ask people is, why is that? Where is the downside, really, of in the short term and the long term? Where's the real downside for me constantly providing valuable pieces of information to tech companies about my life? Where's the real, serious, philosophical downside?
Mm-hmm. Yeah. So, to your point, it could be tech companies, it could be credit agencies. Anytime that you're signing up for an account and it involves some financial activity, whether it's a bank or an exchange, or like tech companies taking your personal information, or like healthcare companies needing to take your personal information. Anytime those type of activities occur, there's often regulations enforced by the government that say you need to take in that person's personal information. And we're not just talking about name and maybe like an email or something. We're talking about that person's phone number, their address, their social security number. And sometimes it gets even further than that. And the problem with these types of regulations is they obviously infringe on your privacy, right? But the biggest thing is this information gets hoarded in these centralized databases. And these centralized databases are easily attacked by hackers. And we see these massive breaches that occur. Every few months you hear another company coming out saying we had a data breach and a number of customer information was potentially exposed, and we're working to figure out what that was. And there was like that Equifax hack that happened a year or so ago, and we're talking about like a significant portion of Americans, their most sensitive personal information was exposed to third parties, because we have governments that are saying, to combat anti-money laundering activities and other, criminal activities, we're going to force these companies that have proven that they cannot properly custody their customers' data. We're going to force them to take all that data and put it in essentially a gold mine for people to go and hack and then go sell on the black market and do whatever. And so in 2020, you should probably assume that your most personal information is out there and up for sale on the black market right now, because of these types of regulations that governments enact under the story of wanting to fight, terrorist activities or money laundering activities or whatever it might be. And frankly, it's because governments are lazy and they want to be able to easily spy on you and see transactions and things like that to know what you're doing, so that they don't have to actually get out there and enforce laws, right? Like to partake in real law enforcement activities, real, detective work or real investigative activities. And so because essentially our governments have become so lazy and they're forcing us to just surrender our most precious personal information to all of these essentially third parties, right, who have these centralized databases, it poses significant risk to us, right, when it comes to potential fraud and things like that can be carried out against us when this information gets in the wrong hands. And it does invariably. Every few months you hear about another big hack with another big company.
Okay, yeah. I mean, that paints a very practical, reason for why the fraud and the identity theft risk to your average person. It's like, okay, your information is being stored perhaps irresponsibly because of maybe some lazy institutions that enact certain policies and expectations for disclosure of information, and then that information gets stored and it can get hacked, and then people can buy stuff with your credit cards and assume your identity,
Right.
all sorts of like bad stuff that we're very aware of how bad that can end.
So real quick to that point, my argument is the net cost to society is significantly higher on that side than the benefit to governments to be able to stop anti-money laundering type activities, which really make up a tiny, tiny portion of everyday transactions throughout the world. You know what I mean?
Right.
I believe that the net cost to society is a significantly higher cost than the value that's actually going to these governments in terms of enforcing these types of criminal laws.
Okay, so what you're saying is that the problem that they're addressing is not as big as the problem that they're adding into the system, which is it's like, okay, for example, it's like the whole terrorism thing.
A complete invasion of privacy, right? Okay, go ahead. Sorry.
So, the topic of terrorism is it terrifies people. I mean, that's why it's called terrorism. And but the actual reality of terrorism is that it's astronomically rare and affects a ridiculously low amount of people. But, I had somebody tell me that, they like thoroughly believe that the TSA is unnecessary because the chances of someone hijacking a plane is so low that like every person who flies on a plane needs to go through this big long process and get checked, and it has like a real serious cost to like the economy or whatever, time cost or whatever, and that it's really like an overblown reaction to the real risk of terrorism. Now I would say that I think it was one of Taleb's books that talks about how there's certain things that could happen that are so bad that you would actually want to spend a significant amount of your resources to just prevent it from never happening at all. And like another 9/11 is kind of like a good example of that, and that's why the TSA exists.
Yeah.
Even though it has like serious downside. Now, what you're saying is that the risks of bad actors committing acts of fraud or identity theft or whatever when it comes to stealing people's information from these potentially big, large, centralized databases is actually pretty significant, and it's actually it's adding long tail, fat tail risk to a situation that didn't really have that same type of risk. Because yes, some people are going to steal other people's identity. Some people will commit fraud, and some people will launder their money through various, institutions. There's going to be crime, right?
Yeah.
With 330 million people, it's in our country. There's going to be crime. There's going to be some crime, but it's not enough crime, and it's not enough. It's not enough of a problem in order to essentially risk, going down some sort of Orwellian path as a surveillance state, right? Is that what you're saying?
Yeah, and that's what this has become. It's become a full-fledged surveillance state where there is visibility into every transaction you make, right? And you should have the liberty to say that I want to have certain transactions remain private. I don't want everyone to know what I like to do in my private life all the time, right? And you talk about the amount of criminals out there, right? I would say probably 99% of the transactions happening, they're not related to the types of laws that are ultimately requiring you to surrender all of your personal details. And those personal details then get turned around and stored in a centralized database that inevitably gets hacked. It's, again, invariably happened every so often, every so many months, you hear about another hack of a big company, and a lot of people get exposed. And that Equifax hack that I mentioned earlier, that was a significant portion of Americans that were exposed to that hack. I'm not talking about like a couple million people. I'm talking a lot more than that. And so you take it together, these individual instances, and you collectively start to measure them, and you start to realize that the cost to society is significant. And then that doesn't even take into account the fact that you have government looking at pretty much every move that you make from a financial standpoint. And that's really dangerous for a lot of different reasons. We can get down that Orwellian slippery slope if we want to. But anyone that's read these types of books, anyone that's kind of looked at other instances in societies outside of the U.S. realizes that there isn't a whole lot that people can do to combat these things other than figuring out a way to decentralize the information, right? And that's how all this ties together, because we're talking about instances where we have centralized information that's easily attacked, right? And the way to combat that is to have decentralized systems that allow you to maintain your data privately, to custody your data, to not get monetized by, a Google or whatever it might be, right? To not be surveilled by your local government or federal government, and so on and so forth.
So do you think that cryptocurrency and blockchain, just as a blockchain in general, as a way for information to be organized over the internet?
Web 3.0. That's what's being built right now. And it's going to be built, the base layer is going to be one that is made up of, in the next 10 years or so, it'll be made up of a number of different blockchains that are all interoperable, which means that they're able to communicate with each other. And so like if you have like your Venmo account and your Wells Fargo account, well, like within your Venmo account, you can only Venmo other people. Well, with interoperability, you'd be able to send payments from Venmo to Wells Fargo, right? And so even though they're different platforms, they ultimately are able to communicate with each other. And you're going to see this happen, a proliferation of probably a number of blockchains that ultimately create Web 3.0. And the user experience, it's going to be just like, going on your phone right now. It's going to be seamless for the user. But in the background, this technology is going to be securing the user's data for them. Right now, there's a web browser called the Brave browser. It has like well over 10 million monthly active users. It's a blockchain project, and it essentially demonetizes the user's data. The user gets paid to click on ads at their discretion. So if you click on an ad, you get paid in the currency on the platform. And advertisers access the users on the platform by using the currency on the platform to pay for ads to be targeted to them. And then in turn, the users can choose whether they want to actually view those ads. And if they do, they get to collect a portion of that ad revenue that comes to the platform. So it's a win-win-win for the platform, for the advertiser, and for the user, because the advertising is actually going to be a lot more targeted toward the user now. And by the way, Brave browser uses Google Chrome's open source code. So it's basically a better Google Chrome because it blocks all ad trackers. It blocks pop-ups and all that stuff. So it runs more efficiently. I actually use it every day. It's a great product. But that's a great example of how Web 3.0 is going to solve a lot of these issues over time.
So you think that in the future, people are going to be more mindful of the information that they're actually providing to these tech companies, because it's going to be, okay, so here's one of my bold questions. Why, what is going to be the thing, what is going to be the reason for the average person, like my mom, to be like, I'm no longer going to be, using a platform that uses my data in order to essentially gain leverage over me and other people, right? By using all this data and using my demographics and all that, and ultimately just like taking advantage of the fact that humans are really predictable people. I mean, that's
human nature.
The whole reason why this stuff works and why your data is valuable is that human beings are predictable. Generally speaking, is that we're pretty predictable, right? If you fall into a certain specific demographic and you do this, that, and the other thing, well, then there's a bunch of other people that do that same thing, and you guys all buy the same stuff, right? Generally speaking, and we're predictable enough to be able to reliably sell stuff to. Sell us things that we didn't even know that we wanted, just because we right. reside in a very specific demographic that we didn't even know that we resided in. So what's going to be the thing that kind of gets everyone on board with the idea that our data is valuable and we're no longer just going to just give it away for free?
Right. So like it's kind of like what you mentioned. So human nature here is very clear to me. We will sacrifice our privacy and sometimes security in the name of convenience, right? So like when an interface is really easy to use, like an Amazon Prime or whatever it might be, and the product is very convenient for people, well, they're going to make that trade-off, right? And say, okay, I'll sacrifice some of my privacy. I'll give you some of my data that you can monetize because this is such a convenient product for me to use, and it provides value for me in that way. And so that's the trade-off people make. In that situation, the technology has not existed to where the person can still get that level of convenience while still protecting their privacy and their security, right? And so while the technology now exists today to potentially do that, it's still not there from a user experience standpoint. And so it's not as convenient as the traditional big tech platforms like we see out there, but it's getting there. The innovation's coming from the user experience side, from the application side. And so once that like I mentioned, like soon enough, using this, it's going to be very seamless and it's going to be blockchain and all that stuff in the background. And I'm not even going to be noticing that because I'm not truly interfacing with the blockchain. That will eventually come. And I think people every day are becoming more and more aware of the reach that government has, the reach that these companies have in terms of being able to peer into your life, right? And as soon as a product comes along that doesn't significantly sacrifice convenience compared to the products that they're using today, that can give people back their security and their privacy, well, I think they'll eventually make that switch. But I don't think we're necessarily there yet, right? It's certainly a longer term trend.
Okay, yeah, I think that this is fundamentally optimistic because what you're saying is that there's a philosophy.
Long human ingenuity.
Well, there's this idea that the only reason why these superior philosophies aren't being adopted at the scale that they ought to be is because at the surface level they aren't quite as sexy as the legacy technologies that we're all used to. And I guess the question is what's going to wake people up to go, oh shit, if I had to choose between this thing that I've been using for a long time and I'm really comfortable with it, whether it's like Facebook or whatever, right? Because my friends use it and it's convenient and I know how to use it and I don't like learning new things. What's going to cause people to go, oh, you know what? I'm gonna go with this new thing because I'm more on board with the movement and the message and the philosophy behind it all. It's like, again, it's like necessity, man. What's gonna do we need a crisis of do we need like a scary thing to happen that scares people into going, oh shit, our data, man, it's we need to be mindful of it.
Yeah, so humans learn best when they're forced to like suffer or struggle, right? And so like there's one scenario where things get so bad that people realize, oh my gosh, I have to make this switch, which I don't think is going to be the case. What I think will actually be the case is these new technologies that come in, they're going to incentivize people to make the switch because people like in the Brave browser example I gave you, I make money by clicking on ads now and viewing those ads and giving my attention to the network, right? So on the old platforms like a Google or whatever it might be, they get my attention and they're able to get my attention for free. I'm providing that attention for free and they get to use all the data that comes along with that. And they're giving me a free product to use in exchange. Well, now in this Brave example, the advertiser's coming on and saying, we are going to advertise on this platform because there's a certain amount of users and we think it's valuable to advertise to these users. We're going to pay a certain money to do so. The platform is not hoarding user data or anything like that. It's incentivizing users to use it because one, the experience is as good or better, but two, and more importantly, if I use this platform just for my normal web browsing activities, well, whenever an ad does come up, like you would see in the bottom right corner of your screen when an email pops up, you can choose to click on that ad or not. And if you click on it and view the ad, it comes up in a new tab on your window. And I now got paid just for doing that, right? So I now have a financial incentive to come to this new type of system that these technologies are offering, right? Where instead of having the company that owns the platform that get to monetize my data, I now get to monetize my data, right? And so as people become more and more aware of these things, the adoption will take place, right? So like you had MySpace with all the network effects in the early 2000s as like the social network. And then Facebook came along and it was a superior product for different reasons. And slowly but surely, MySpace got disrupted and Facebook has grown into what it's grown into today. So I think you'll see these network effects slowly and gradually take effect as we see these products come along that empower the user and put the data back in the user's hands to a point where they could potentially monetize it as well.
For more conversations about why the 21st century is going to be the strangest time in the history of the Earth, be sure to subscribe to the Highly Uncertain podcast on YouTube, Spotify, or iTunes. This episode is sponsored by BetterHelp, a really cool company that offers professional counseling and therapy services online and on your own schedule. Learn more at betterhelp.com/Chris. See ya.